Hey everyone, this is Joseph, and welcome to my first FOMC debrief. For those of you who don't know me, I used to work on the Fed's trading desk, and now I operate a blog, fedguy.com, where I teach and write about the markets. So, the FOMC has ended, and if you look across asset classes, you'll come away with the impression that the FOMC was very dovish. Now, to be clear, you have to exercise some caution when you interpret market prices on these days. There could be a lot of hedging activity going on where hedges have been taken off, for example. But looking across asset classes, you'll see that risk assets, so equities, up strongly, the US dollar sold off strongly, and yields are lower across the curve. So that is unambiguously a dovish impression. Now, I actually agree with that, and I would say, though, that this dovish Fed meeting sets us up for a more hawkish Fed meeting later in the year. But before we dive into today's FOMC, I like to level set as to where we are. So if you think back over the past few months, the Fed has been hiking rates aggressively. So the Fed has two mandates, full employment and price stability, which means inflation of around 2%. Now, the labor market has been very strong with unemployment around multi-decade lows. So the Fed has been doing very well on its full employment mandate, but it's doing very badly on its price stability mandate with inflation, say 6-7%. So because it felt that it was doing well on its full employment mandate, it felt that it could aggressively tackle its inflation mandate. So when the Fed hikes rates, usually there's a trade-off between employment and inflation, where when you hike rates, you slow down the economy and you raise unemployment, but you also tackle inflation, so put downward pressure on inflation. With the full employment mandate met, the Fed was free to tackle inflation aggressively, and it did so. So the past year, it raised rates at an unheard of pace of 75 basis points a meeting, and aggressively over the year, we're now at around 4.5 to 4.75 on the federal funds rate. So when the Fed looks at inflation, it breaks down inflation into different components. Now, Chair Powell has been very clear that he looks at inflation in three categories. First is housing, so rent, and the second is goods, so the stuff that you buy, and third is services ex housing, so things like dining or travel, for example. Among those three categories, the Fed has seen pretty good progress in getting inflation lower in two of them. So during the pandemic, a lot of people were at home and they all ordered a whole bunch of stuff. And when everyone is ordering a whole bunch of stuff at the same time, you get tremendous demand in goods, and the supply side wasn't able to react as quickly. And now that there's more, I guess the people have normalized their demand, their purchase habits, and supply chains have improved a bit, you have moderation in goods prices. When it comes to rent, the leading indicator, so rents on leases most recently signed, suggests that there's moderation there, and that will eventually feed into housing disinflation as well. The third category is the category that Chair Powell has been focusing the most on, services ex housing. Now, services ex housing has been a problem for the Fed because the labor market is really strong. Because the unemployment rate is around multi-decade lows, you have wages increasing significantly. And labor costs are a major input into services ex housing, and so when labor costs go up, so do inflation in services ex housing. So that's what the Fed has been focusing on. And heading into this new year, we see good developments in everything but services ex housing. There has been some indication that the labor costs have been moderated recently, but still we're higher than we were in the pre-pandemic era, but we're heading in the right direction. So that's where we were heading into this FOMC. Now, as a principle, the Fed doesn't like to surprise markets, so it always telegraphs well in advance what it's going to do with the policy rate. And it telegraphed that this meeting it was going to hike 25 basis points. What many market participants wanted to understand is its forward-looking trajectory. Is this the last hike? Does it plan on hiking even more? Or what is it thinking right now? As of December, the Fed's projection suggested that they would hike rates to around 5% and keep it around 5% throughout the year. The market, on the other hand, is pricing that the Fed hikes one more time after today and then begins cutting rates later in the year. So the Fed's expectation and the market's expectation were very wide heading into this meeting. Today, right off the bat, based on the Fed's statement, we saw that the Fed was anticipating additional interest rate hikes. So right off the bat, people who were expecting that the Fed would do hike one time this year and end, they were disappointed. So the Fed is telling you that so far they've maintained their forecast on interest rate hikes, and they'll have new forecasts out in March. So far it would seem like this was a hawkish meeting, but here's where the dovish part gets in. Now the Fed Chair Powell had multiple chances to push back against the implied easing in the financial markets. And he could have easily said things that, yeah, the markets are pricing in rate cuts, but there's no way we're going to do that. We're going to keep financial conditions very tight and so forth. But he didn't. Now, to be fair, Chair Powell was very clear that he's going to keep at it until the job is done. But without explicitly pushing back against the easing in markets, the markets seemed to feel that they had a license to continue pricing in implied easing. Now, Chair Powell's response to this was that, well, according to the Fed's inflation forecasts, rates are going to have to stay higher for longer. The market is probably forecasting something different. The market is probably forecasting that inflation will come down very quickly. And according to that forecast, maybe the Fed would cut rates soon. And Chair Powell was open to adjusting his expected path of policy if the inflation and economic data were different than his current expectations. So he's data dependent, basically. The problem with this is that financial conditions have loosened a lot over the past few months. So the Fed does its thing and adjusts short-term interest rates, and that influences longer-term interest rates. But longer-term interest rates are also significantly determined by the perception of the market. And when the market perceives that the Fed is going to cut soon, they price that in, and mortgage rates come down, risk assets rise, and the dollar weakens. And that kind of has the potential of setting inflation on an upward trajectory again. The CEO of Redfin most recently on Twitter suggested that he was seeing housing activity begin to pick up again in January. And if you look at mortgage rates, they were very high, above 7% a few months ago. Now they're trending lower, and it'll probably be close to 5.5% soon. And if you look at asset prices, the S&P 500 comfortably above 4,000. So if you're someone who has a brokerage account, has some exposure to equities, you feel a bit wealthier. Maybe you have a bit more money to go and spend to buy stuff. And during the crypto boom, we saw a lot of people go out and buy very fancy cars and very fancy watches out of their crypto wealth. So by not pushing against the loosening of financial conditions, the Chair Powell, in a sense, is allowing the market to run with its imagination and potentially ignite demand again, and making their job more difficult later on in the year when inflation turns out to be not so transitory, to have to aggressively hike rates again. So that's something that's not certain, but so far though, looking at the totality of the data, from my perspective, it seems like the loosening of financial conditions when the labor market is still very strong and the underlying U.S. economy appears to still be growing and to be resilient seems to be a recipe for repeating the mistakes that we did in the 1970s and 80s. So in the 1970s and 80s, the U.S. had very high inflation. The Fed would hike rates, and then they would be worried about growth. They would think that inflation is ebbing. Then they would cut rates, and inflation would roar back. Now, Powell has been very clear that he doesn't want to repeat that mistake, but financial conditions are not simply about short-term interest rates. If the market begins to think that the Fed is going to cut rates, then financial conditions ease. And unless the Fed pushes back against that, then there's I think a meaningful risk that we see inflation resurge just like we did back then. So I guess that's all for today, and hopefully that was helpful, and can't wait to see how things turn out in the coming weeks.